All right, so good morning, good afternoon, good evening, depending on where you are in the world. Welcome to the Pinnacle Institute and an informational session on some of the most common traps that you'll find in the financial markets to make sure that you guys are always on the right side of it. So before I get started here, if I could just give me a quick hello. Actually, everyone type in where you're listening from. I like to see where everybody's joining in from, but welcome everybody. I will be your host here for this session. My name is Shamus O'Connor. And if you like the information in the session today, please give us a like down below. And then also make sure that you take time to subscribe to our channel. And the reason why is because every week we're going to be putting out great content like this. And it's all content designed to educate you in the financial markets, as well as some great education on our proprietary strategy, the Pinnacle Method. So investing and trading can be a tricky endeavor, and there are many tricks and traps that can cause the novice investor to lose money. So before you ever do any trading and investing, it's just really important that you recognize these dangers so you don't get hurt. But here are some of the common traps that we'll be covering today. We're going to talk about some of your popular indicators and oscillators. Then we'll go into some of the chart patterns. We're also going to talk about support and resistance, how a lot of common traps can be found there. We're also going to touch on some traps that can be found from earnings and your fundamental information, news, as well as broker upgrades and downgrades. But before we get into any of the traps, it's really important for everyone to understand that the markets themselves are actually a net sum zero game. Now, what I mean by a net sum zero game is for every buy transaction, there has to be a sell transaction. And for every sell transaction, there also has to be an opposing buy transaction. So what that means is that when money is lost in the market, when people lose money, it doesn't just disappear. It just moves into someone else's account. And Sam Seiden, the creator of our strategy, says it best. He says trading is just simply a transfer of money out of the accounts of people who don't know what they're doing into those accounts of those who do. So the goal is to always be on the right side of the trade. Now, over the years, these banks and institutions have actually created a lot of common traps to get the novices to buy when they want to sell or get them to sell when they want to buy. So our goal is to be able to kind of recognize a lot of these common traps so we don't get hurt by them. But more importantly, when we see the trap, we want to learn how to profit from them, right? Now, you may have heard the old saying, if you can't beat them, you got to join them. So when these actually banks and institutions are setting up the traps, we can actually learn to profit from them. But the goal or the ability to do that is be able to recognize on the charts where these big banks and institutions are buying and selling. And that's what this Pinnacle Method is. It's all designed to help our members look at charts and recognize the picture and pattern that represents big institutional buying and big institutional selling. And we'll go into a little bit of that Pinnacle Method with you here today, along with these traps. Now, if you ever want to get more information on the Pinnacle Method and our strategy, we actually have workshops. These are complimentary workshops that you can attend, but we have two different types. We have an introductory workshop over here, and then we have advanced workshops as well. Now, the introductory workshops are going to be for those of you that have never seen the strategy before. So really kind of introducing you to the concept and how it works. So down below here are some dates of the next introductory workshops that we have coming up. And in the chat box is a link that you could just click on real simply and apply. Now over here, we have some advanced workshops. Now the advanced workshops are for those of you that already have some familiarity with Sam Seiden's supply and demand strategy, and you just want to take your knowledge to a whole new level, right? So if you're a beginner over here, but if you do have some experience over here, these might be better workshops for you as well. But just simply click on the link and you can actually pick the date that's appropriate for you, okay? Now, the first traps that we're going to go through are your common, what we call indicators and oscillators. Okay, now these are very common. Like on this chart right here, I happen to have an RSI indicator, I have a MACD, I have a slow stochastic. Right here, I have some volume bars. I even have a chart here that has a Bollinger Band on it, and I even did a Fibonacci retracement from the top all the way to the bottom. Now, give me a yes or a no in the chat, everybody, if you're familiar with any of these kind of traditional tools, these indicators and oscillators. Give me a yes if you're familiar with this stuff, but give me a no if it's something that's brand new to you inside the chat. And the thing is that a lot of people are familiar with this stuff because it's been around for years. But here would be the question. If you're already familiar with a lot of these tools and resources and things that I can put on the chart, the question is, why are you attending this workshop? Why aren't you just using these tools and resources and in the markets right now making bunches of money, right? That's the question. That's kind of the challenge. And what I found, because I have used these in the past, is they just don't work. Okay, and the reason why they don't work is we have to understand that all of these things are what we call lagging indicators. So what I mean by a lagging indicator is some mathematician created an algorithm. It's basically a math equation, and it pulls in price and volume information. And when it comes into the equation, it kind of puts these little squiggly lines on the chart. So what that means, everybody, is that the price and volume action has to occur first in order for the line to update. So when you're using these tools, you tend to get in late and out late every single time. And that's one of the common reasons why they don't work, is because they're lagging. But here's the other thing you have to be careful of. The banks and institutions know that a lot of these novice investors out there are using these traditional forms of technical analysis. And when they know that they're using them, they actually use these tools against them. I always say they kind of know your playbook. I'll give you a quick analogy. I grew up in the Boston area, so I'm a really big Patriots fan. So if you ever ask anybody about the New England Patriots, a lot of people hate them. And one of the reasons why everybody hates the Patriots is because we've won so many Super Bowls. Like, we were basically a dynasty for over 15 years with Tom Brady and such, right? But one of the other reasons people hate them so much is because they say they cheat, right? And, you know, you can't argue against it, because back in 2007, the Patriots were caught filming the other team's defenses. So think about that. If you're a football team and you're filming the other team's offense and their defense, and you know exactly what they're going to do, kind of like their playbook, isn't it easy to go against them when you know exactly how they're going to move and conduct? Hopefully that makes sense to everybody. And that's exactly what happens with these right here. The big banks and institutions know the signals that the novices are looking for here. And believe it or not, they actually create those signals to trap them. And it's interesting for us here at the Pinnacle Institute, oftentimes the sell signal here is a buy signal for us, or the buy signal here is oftentimes a sell signal for us. So let me give you an example. This right here happens to be a trade setup that Sam Seiden presented to our members in a session called the Forum. Now, if you're not familiar with the Forum is our pre-market trading and analysis session. So here's how this works. An hour before the market opens for the day, the markets open at 9:30 Eastern time. An hour before that, Sam gets on board with our members and shares his screen. Now, as he's sharing his screen, he's going to show you the asset that he's looking at and the time frame. He's going to pull up the charts, and what he'll do is he'll mark the areas of supply and demand on the charts for you. And these supply and demand levels are based upon a rule-based strategy that takes into account two considerations: structure and location. So the structure is the picture and pattern that these candlesticks make that represent big institutional buying, or the picture and pattern that these candlesticks make that represent big institutional selling. So one of those things is structure, and the other part of that is having it in the right location, meaning the right spot on the charts. So here's where Amazon was trading at the time that Sam was analyzing the markets. Now, as a member of the forum here, you have the opportunity to see what he's doing, copy these zones, but if you don't understand what he's doing, that's your opportunity to get here inside the chat box and ask some questions. So you can get familiar with why these are good areas where we believe the institutions are buying and selling. But what right here was the current price. Now, as a result, this was on the 10th, over here to the 21st, Amazon did make it down to our area, came back down here, gave our members a buy signal right there. They would have had a protective stop underneath just in case. And then you can see when all that institutional demand came in, we see this big explosion up. It even gave us a second shot at it right here before this explosive movement away. And so when you find these great areas on the chart of demand and supply, they provide us with low risk, high reward opportunities in the market. But this is an example of our strategy in action in front of our live members. Now, let's compare our setup to a classic setup that you might see from traditional forms of technical analysis, okay? So here's our setup over here, everybody. Now over here to the right, I have the same chart, same time frame, but what I did is I just laid on 2 moving averages. So I have a 50 period moving average, and then I have a 200 period moving average. Now, if you're not familiar with how moving averages work, if it's a 50 period moving average, simply what the math is it looks at the last 50 periods and gets the closing price of those last 50 periods, adds them all up, divides by 50, and then it gets you the average closing price over the last 50 timeframes. Now, the way it works is that when a new period closes, it'll update the 50, right? So that means you need that new data in order for the line to update. That's why it has a lag to it. But this is a 50 period and a 200. And these are 2 very popular moving averages that people will put on a chart. Now, notice right here. Notice how the 50 period moving average comes down and it crosses over the 200 period. Does anybody know when the 50 period crosses underneath the 200? Do anybody know what they tend to call that when the 50 crosses down below the 200? Does anyone understand what they call that? If you haven't ever heard this before, they call this the death cross. That's what it's actually called, the death cross. And for a lot of people, this is a huge selling signal right here when it crosses underneath like that. Now let's take a look at that. When the price is crossing right here, as it goes down like that, the sell signal's coming right into the place where we got our buy signal for our members. So everybody that's using that crossover right there, they're panicking and selling right into the place where we want to buy. That's your trap right there, right? We don't want to be selling down here. We want to be buying right here. And a lot of these things are so lagging. Like if you look, like some people will wait for the price to come back and cross above the average before they start getting in. Well, think about that. If you're waiting for it to cross above the average right here before you get in, you're basically buying right up in here. Do you realize that oftentimes the buy signal right here is getting pretty darn close to the area where we would be considered selling based upon our strategies? So hopefully this is a good little evidence of how oftentimes these classic signals can encourage people to sell where we're looking to buy, or actually encourage people to buy where we're looking to sell. Almost the exact opposite like that. So here's another example here. This one here was on Apple Computer, and this came from a tool that we have called the Pinnacle Gallery. Now, if you're not familiar with the Pinnacle Gallery, basically what we do is we give out supply and demand zones on over 50 powerful markets. So they could be levels that we do on stocks, ETFs, we do futures, and we even do forex currency pairs. But basically how it works is we start with the current price and we identify 2 levels above the current price and 2 levels below the current price. Now we have short-term levels, which are more designed for your active day traders. And then we have mid to long-term levels that are more for your swing and position traders. So over here on the 12th, we identified a great looking demand level on Apple. Now these 2 numbers right here on the gallery help our members with their line placement. So these numbers are designed to have them capture the area where we believe that there's big institutional demand that meets our criteria between structure and location. So you can see here we have this explosive kind of movement away, kind of a retracement, and that was the origin of this big movement up. So when we have this evidence of institutional buying, whenever the price returns back to this area, we're looking to buy right here with the protective stop underneath. And then when all that institutional demand came in, you could see this explosive movement away. Another low risk, high reward opportunity in the markets. Now let's compare this setup to another classic setup with an indicator and an oscillator. So here's our Apple opportunity here. Here was our buy setup right here. Over here, I have the same chart, same time frame, same Apple computer on a 120-minute chart. But down here below, I just put on a MACD. Okay, so if anyone's looked at a MACD before, basically it's a moving crossover system. So whenever two moving averages cross each other, the squiggly lines will cross the zero line. But a lot of people, the way they use this indicator is they wait for the price to cross the zero line. And when it crosses the zero line right there, that is a classic buy signal for a lot of people using this indicator down the bottom. Now let's take a look at that. Imagine you get the crossover of the zero line like there. And then if we take and chase this straight up, right? Look where it's telling everybody to buy. It's having everybody buying right here. Now imagine the people that's buying in right there. Soon after that, what does it do? It just reverses and goes completely the other direction. We never want to be buying up here when the signal's going off. Don't we want to be buying down here, right? So when you have this strategy down, it becomes a leading indicator compared to a lot of your lagging indicators, because we have an understanding of where the price is going to turn before it gets there, right? We don't want to get in after the movement in price has already occurred, because it often takes the movement in price here to trigger the signal going off right here. And again, all these are doing is having people buy high or sell low. But a lot of people are selling down here right in the place where we and the institutions are hitting the buy button. So this is something that we definitely want to get rid of. We just want to take all of these squiggly lines off the charts and just focus on the candles and start to recognize the rules as to why this has great structure and location as a low risk, high reward buying opportunity. Now, some other common traps come from your classic chart patterns. So here I have some of your classic reversal patterns. So up the top here, these are trend reversal patterns where the market stops trending up and begins to trend down. And then down the bottom here, these are classic reversal patterns where if the market's trending down, they begin to trend up, okay? Now we have to ask ourselves, what's the problem with all of these patterns? Well, if you recognize some of these patterns, let me show you where a lot of the buy and sell signals are on a lot of these common chart patterns. Right here, we have the classic double top. Now on the double top, the way the books teach it is they'll tell you to sell as soon as it breaks the bottom down here. So that means that you're selling as the price is dropping, selling down here. On your classic double bottom, which looks like a W, all the books will tell you to buy right here, this breakout. When it breaks this top right here, it'll tell you to buy this breakout. So simply by following these two patterns, it's teaching people how to buy high and actually teaching people to sell low, right? They get you almost the complete opposite of what we should be doing, right? We don't want to buy high. We're actually trying to sell high, right? And we don't want to sell low. We want to buy low, right? But these are getting everybody in the world that's using them upside down on their trades. So let me give you a great example. This one came right from Charles Schwab Education. This is a snapshot from their website. And actually, clients of Schwab get access to a lot of free trading. But the free training that they're doing here is all going to be your classic chart patterns and those indicators and oscillators that get you in late every single time. But here's education on how to actually trade this pattern. So it looks like it sounds. You got your shoulder, you got your head, and then you got your second shoulder. So when people see this pattern setting up, when it breaks what they call the neckline right here, that is your indication to sell. Now the profit target is a measured move, and it's based upon the top here to the neckline right here. So this is how much we expect the price will move and when the pattern fulfills itself. So everybody in the world who's watching and reading this education, they're going to hit the sell button right here. So if we look at a chart here on oil, this is an oil's futures trade. We have our setup, our pattern. We have our shoulder, then we have our head, and then we have our second shoulder, right? So everybody in the world is going to draw a neckline right there. Now, as soon as they draw that neckline, whenever the price breaks the neckline, that's going to be their trigger to sell. But look at how low they're selling. They're selling after a massive drop in price. And when you sell way down here, everybody, all you're doing is increasing your risk and actually at the same time decreasing your rate of return, okay? Now let me show you how this setup is handled here at the Pinnacle Institute. So if you look at this right here, here's another setup that we had from the Pinnacle Gallery. So futures is one of the markets that we track, but here we had on crude oil, our supply zone. So these two numbers here help our members with the placement of their two lines, but basically what this is indicating is the picture and pattern that we're looking for. So this little area right here meets our structure and location criteria. So that means as the price pushes up into our pre-identified area, this is where our members would be selling oil. They would be putting a protective stop right there and then looking to benefit from this drop away, right? So think about it. This is where our members are getting into this opportunity with the protective stop here. The rest of the world is getting in down here. So I want you to think about that. By the time the pattern fulfills itself, where everybody's starting to sell, this is where our members are starting to take profit. And oftentimes what you'll see is it'll break the neckline on a lot of these patterns, and then it will reverse quickly the other way. And it will catch a lot of those traders into that trap. And if you actually look at Charles Schwab, they have 29 million accounts. So there's 29 million people that have access to this information. Now, do you guys think that the big banks and institutions know that every single person that read the education at Charles Schwab is actually going to sell right there? And they're pulling them into these traps, these common traps. We don't want to be selling down here. We want to be selling up here. And by looking at the right picture and pattern, structure, and location gives us the ability to actually do this. And I see the worst is some even charge for this stuff. Yeah, Jose, here's you know what I actually think, Jose? It's interesting. I think Schwab gives all this information away for free to get people to come become clients. And I actually think they don't even want people to succeed. I think they actually want people to struggle in the markets so that once they're a client, they can move them into a managed account. They said, okay, you can't do it on your own. We got professionals that can do it for you. That's what I actually think they're doing. I don't know. That's just kind of my little conspiracy theory there, but that's what I truly believe. And all this stuff is just getting people upside down, okay? So another common trap that you get out there is support and resistance. It's a very popular technical analysis out there. But support and resistance, I feel, is one of the most subjective forms of technical analysis out there. And the reason why I can say that with confidence is if I gave everybody in this session here a book on support and resistance, right? And let's say you read it for a week. And after the week was up, I hand you a chart like this, right? And I said, do your best to mark the support and resistance lines on the chart that I just gave you, okay? So it looks like I have like 34 people watching right now. Imagine if you all have the same book and you're all looking at the same chart and you start marking your support and resistance. When I collect your papers, out of 34 of you, can anybody guess how many different answers you'll tend to get? Different answers you'll tend to get out of 34 people. Believe it or not, everyone, I'll have 34 different answers. And that's a problem because if you're all reading the same book, you should be coming up with the same conclusion, but people don't. So that's telling us that this form of technical analysis is very, very, very subjective. So that's one problem with it. The second problem with it is this. A lot of your common traps come from it because these banks and institutions know where all the novices are setting their lines and they actually trap them. And so I'm going to show you some examples here as well. So let's see, what's your view about oscillator divergence and convergence? Don't use that either. Again, it's super, super late to the game. And if you actually do the divergence and convergence against our supply and demand levels, you'll see that they're crazy late as well. Yeah, so we don't use any of that, none of this stuff here. But this is an area right here that Sam marked off for our members in our forum session of demand. Now, this little place right here where we have this explosive movement in price is meeting our criteria of structure and location. So this is an area where we believe there's large institutional interest for the asset, a lot of what we call unfilled demand at this area. Now, if we look at where the current price is, prior to this area right here, you're going to see lots and lots of turning points along the way, right? Now, one thing that's real critical to understand about our strategy is just because prices move up doesn't mean it's a demand level. And just because prices move down doesn't mean it's a supply zone. It has to meet all our criteria of structure and location. So there's a very, very specific set of rules that say that this is a demand level and some of these other areas along the way are not. Because if any of these areas along the way were demand levels, understand that Sam would have all of these levels marked for our members, but he doesn't. Now, if I'm a student of support and resistance, if the price is right here, this is what I'm gonna do. I'm gonna draw a little horizontal line there off of this little pivot. I'm gonna draw a little horizontal line there right off of that little pivot. And then I'm also may draw a little horizontal line right there off of that pivot. So these three right here are classic support levels. Everybody in the world who read a book on support and resistance are gonna have these lines. Now again, notice how Sam didn't draw anything off of here. He's down here. He completely ignored these other turning points along the way because these don't qualify as demand levels. This does. Now, if someone didn't understand the difference, they're going to try to buy off of these levels of support. But watch what the result is. As a result, the S&P collapsed. Now, when it collapsed, notice how fast it moved down. It moved down so fast, it didn't even consider some of these other little so-called support levels along the way. So for the people that were buying off of these levels, they got stopped out. Or if they didn't have a stop out, they're taking a tremendous loss on that. So let me get your comment there, Jose. Confused support resistance for yeah. And it's interesting, Jose, because if you mess up the two, it's interesting because oftentimes you'll get caught into a lot of traps. So I'll kind of give you guys a little example. See this support level right here? Right here? Everybody in the world is going to buy off of this little area right here, which is this right here. Okay, they're going to buy right there. Now, when they buy right there, if they have risk management, their stop is going to be just underneath that, right? And here's what will happen: the price will come down. All the novices will buy right here off of that. The institutions will do what? They'll break the line on them, trigger all their stop losses. And then it will have them sell right into the critical buying spot right there. And then boom, it explodes the other way. So if you guys are picking support and resistance levels and you see the price break your line and then sharply reverse the other way, you're getting caught into one of the most common traps out there. Because you have to understand, these institutions know exactly where the novices are going to buy. And furthermore, they know that their stops are going to be sitting right underneath that. And what they do is they break the line on them, trigger all their stops, and then all the novices end up selling right into the place where the institutions want to buy. And there you go. There's your explosive movement away. So we would never buy off of any of these levels here. We're going to be buying right here. This meets our structure and location criteria. This is a strong indication of institutional buying to us. So very low risk, high reward opportunities. This is what we would call a bear trap, right? So we're going to be buying from those people that are selling. So we don't want to get caught into the trap. We want to make money from it. Let me give you another example. Here's one here Jasmine was doing in front of our live members. This one here was on the dollar Mexican peso currency pair. So the strategy works for futures, like I showed you on the previous screen. It works for forex. You can use it for individual stocks. You can use it for options trading, even cryptocurrency. So you could basically use our strategy across every single asset group. It's the same exact rules. It's just a different asset. So this one here is a currency trade for any of you that trade the spot forex. But here's where the current price was. Okay. Now up here, Jasmine has a supply level, and this meets our criteria, structure, and location. This is what we call a classic drop, base, drop, strong move away, but strong indication of institutional selling right here. So this is where we believe there's a lot of unfilled institutional supply. Now, if I'm a student of support and resistance, this is what I'm going to do. I'm going to draw a horizontal line right there. Now, I may also draw a horizontal line up here as well, but these two red lines would be resistance. This is supply. Big difference in between the two, right? A lot of people mistake the two, and when they do, they get caught into a lot of traps. So imagine if the person who read the book, they're going to draw the line right there. Now, when the price comes up to here, this is going to be their signal to sell. But we would never sell right there. We're going to sell right here, right? Now, watch what the result is. As a result, the person, when the price came up to the resistance, they would have sold right there. Guess where their protective stop is? just above it, right? And what do? They crack the line on them, stop them out, and then sink it down. If they tried it again right here, crack the line on them, stop them out, sink it down. Same thing here. Crack the line on them, stop them out, sink it down, right? We would never sell at any of these lines right here. But when it does come to the right spot, this is where we're going to sell with the protective stop above and then benefiting from this beautiful drop away like that, right? And this is another trap, right? Because you got to think about it like when everybody's selling this resistance, they know that their stop losses are just above that, right? But this is also a common trap for the breakout traders. I don't know if anyone's ever traded a breakout before. I call them the fake out breakouts. I call them the fake out breakouts because, like, here's what will happen. See this little pivot right there? That little pivot right there, everyone will draw a line on top of that. And what will happen is when the price breaks this line, this little pivot right there, every breakout trader in the world will hit the buy button right there. And the reason why they're going to hit the buy button right there is because they feel the price is going to keep going to the next resistance. So it breaks there, they hit the buy button, but now they're buying right into the area where the institutions are selling, and then price reverses. So all that breakout trader did is get caught into one of those institutional traps. Very, very common out there as well. So you got to be careful because there is a huge difference from your classic resistance and support levels as to what pure supply and demand is. So it's important to understand all the rules of structure and location, why this makes it a good spot and this doesn't, even though the prices have fallen there, okay? Other common traps come from a lot of your fundamental type information. So if you're not familiar with fundamentals would be looking at earnings statements, PE ratio, growth rate, a company's balance sheet, their product, their management team, that type of stuff. You have to be very careful of that. And the reason why I say that is because when all the fundamentals are fantastic, all the things are great with the company, the question you have to ask yourself is at that moment, are the prices going to be high or are they going to be low, right? So good fundamentals often encourage people to buy in when prices are at their highest. I would argue it the other way. We should actually be buying poor fundamentals because don't you want to buy low? You want to buy when prices are extremely low, not when they're extremely high, right? So I would argue the opposite. I would argue you should be buying the poor fundamentals and selling the good fundamentals. But a lot of people don't do it that way. They almost do it the completely opposite. So we have to be really careful with earnings because a lot of your common traps will come from earnings. And the earnings are on calendars, so we're aware when all these earnings are coming out. But here's why I want everyone to be careful. If you ever know that a company is having an earnings event, please do not take the trade before the announcement. Because if you're taking a trade right before the announcement, you're simply just gambling. You're putting your chips on red and black and you're just spinning the wheel and you're just hoping it comes out the color you want. Don't gamble, right? Instead, what you want to do is wait. You want to wait for the earnings to come out, and then when it creates a reaction in price, then look for a setup. Does that make better sense to everybody? Is to wait till after the earnings for the setup? Because the earnings will actually create emotion. It'll create either greed or fear, and it will create price movement. And what it does is it actually drives price into these critical levels of supply and demand on the chart, okay? So the one I want to show you here is on Amazon. So this is a recent example. Now this is a daily chart of Amazon, but follow along with me. See how the price is going up, 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 and away like that? It stops right here and then just absolutely collapses out of that area. Now, everyone, this is what we call right here a pro gap. And the reason why we call it a pro gap is because the price gapped down in the opposite direction of the trend and was able to completely reverse the momentum. Now, you got to think about that. In order to completely reverse the momentum and whip it the other way, there has to be a tremendous amount of selling right there. And that's not you and I. It has to be a whole lot bigger a player, right? Like a bank or an institution. Because if you and I sell a few shares of Amazon, we'll never create a drop like that. So we know there has to be a big, big, big seller behind that, right? Now, several months later, Amazon starts making its way back up to that exact same spot. Now, on this date right here, April 29th of 2021, Amazon sales surged 44%. They smashed their earnings expectations. And what happened? The market started trading up in the post-market and into the pre-market. Now, it had closed right there at the bottom of that candle, but it opened right here. So the price opened right there, shot up into our institutional supply zone, big, huge collapse away. Now, think of what the novices were doing on the opening bell right there. What are most of the novice traders going to be doing right there on that opening bell when they hear this amazing news? Think about it, because everybody wants to be part of that. They're like, blew out the earnings. They had incredible results. Everybody jumps in there to buy, but that's exactly where the institutions are selling. So novices buying on the great news right into the spot that meets our criteria of professional selling with this pro gap that we have right there, right? It's important not to trade around earnings. They can be too volatile, but you understand that most of the earnings happen when the market's closed, right? So because the market's closed, those often create gaps either up or down. And the problem is when you get gapped, unfortunately, our stop losses don't work when the market's closed. They only work when it's opened. So if you ever get gapped on, you could potentially lose more than what your plan suggests. Yeah, I mean, that may have something to insider trading may have something to do with it as well. But obviously when we get big drops like that, we know that there's a big player behind it. You know, and it could be a bank, an institution, a professional. But we don't ever want to be buying into places where there's evidence of that professional selling. So you got to be very careful of these as well. But this just created us an opportunity, right? Because our members aren't buying right here. They already had identified this area right there, and they are selling to that novice buyer and turning this trap into a great opportunity right in here. But a lot of people would say, Shamus, you're crazy. Why would you be selling Amazon on these great earnings? Well, we don't care about the news. We just care about the pattern on the chart. The pattern on the chart is telling us what to do. Sam always says, trade what is real, not what you feel, right? Let the charts take all the emotion out of the trade. Let the charts tell you the proper decision on what to do, okay? So here's a little news trap right here. This is a little setup that Jasmine had on the S&P. This is a recent one here. This is on the futures market. Here's where the current price was. And just below that, she has a nice little demand level marked here that meets a lot of our structure and location criteria, a little classic rally-based rally. And then just underneath that, we have another one. So here's where the current price was. So what we'll be doing with these live members is we're going to be buying the S&P as it comes down to here. Now we'll have a protective stop underneath. Now, if we get stopped out, so what? We'll just go for the next one underneath, right? But we're always going for the one that's closest to the current price. Now, as a result, on the, I know it's a little tough to see on this picture, but on the 17th, the date of our entry, there was bad news in the market. So you had stocks fall, tech shares were way down, gold was rising, but it was all wrapped around inflation concerns. Isn't that exactly what we saw with the Fed meeting on Wednesday? Fed meeting comes out, gives more fears of inflation, market starts to sell off. But these sell-offs that we have are actually essential. We need these sell-offs and people panicking and selling on news to drive us into the best places to buy, right? We want to buy as low as we possibly can. So we need that panic seller selling us their assets right into here, right into this area that meets a lot of that institutional demand. But think about that, low risk, high reward opportunities. Now, another thing that I want to point out here, everybody, especially when it comes to news, you're going to be buying a downtrend, right? And another very common trap that a lot of people get into is relying too much on the trend. You probably heard the old rhyme, the trend is your friend, right? Well, we don't use trend. As a matter of fact, we go against the trend. We're buying downtrends and oftentimes selling the uptrend, almost the exact opposite of what everybody else is doing. But you have to think about it. If most of the traders out there statistically are losing money, you don't want to be doing what they're doing. You want to be doing the exact opposite of what they're doing, okay? Now, another common traps come from these institutional upgrades and downgrades. So every single day, these institutions will upgrade stocks or they'll downgrade stocks. Now, here's the question for my group. Could an institution downgrade a stock that they want to buy? Or could an institution upgrade a stock that they want to sell? Right? They're like posting an advertisement for it, right? Because imagine like an institution owns a whole bunch of Amazon. Well, if they own a bunch of Amazon and they want to get rid of it, let's say that they feel there's something wrong or the price is going to fall and they need to get rid of it. If they have a very, very large position in that, it's hard for them to sell it unless they get a lot of buyers, right? So oftentimes what they'll do is they'll throw upgrades onto stocks that they're looking to dump, or downgrade stocks that they're actually looking to acquire. Well, what we do is we take these common traps and turn them into opportunities. So I would never buy an upgrade, because think about it. If I'm buying an upgrade, usually the prices are going to be high. If I see an upgrade, I'm looking for a place to sell, but only into an area that meets our criteria, structure and location criteria. So here's a little upgrade that Amazon had on the 22nd. And this happened to be during one of our live forum sessions. Sam was looking at Amazon on a daily chart in front of our live members. The price pushed right up into the supply zone. Now you get a little picture of it right here. This is a classic kind of drop, base, drop, explosive movement out of there. We even have a gap, but the upgrade was able to gap the stock and push it right into the place where we want to sell. Now this is what we call this a novice gap, because the novices run and chase news. So when they're running to buy, as long as it meets our criteria, we're looking to sell and we take advantage of this drop away like that. Okay. Let's see what you got there, Tubi. I thought gaps were price breaks where there was no trading activity. So the spaces between the wicks and the buys. The gaps are actually, the gaps themselves are when there's a difference between the close price and the open price. So I'll just give you a quick example right here and hopefully I answer your question. Right here, Amazon closed. Now, when Amazon was closed, they maybe had some kind of news event, right? So when the market closes at 4 o'clock Eastern Standard Time, I'm not sure if everyone's aware of it, but it'll trade another 3 or 4 hours after the close. And that's what we call the post-market activity. And that's all done in an electronic market. Now, before the market opens at 9:30 in the morning Eastern Time, the market will start its pre-market activity at 8. So all the transactions that were happening in the post-market, in the pre-market, actually indicate the next day's open. So obviously here the news was pretty good because there were people buying Amazon up at this price before the open. So that's actually where it opened and then it dropped away. But that would be the gap. And the gap is created by that post and pre-market activity. So hopefully that if that helps you, Tube, on that with your question there. If not, certainly type in the chat and I can clarify it a little bit more if you like. Okay, but all this did, see here we had the gap up. They had the upgrade, which usually happens where before the market opens for the day, people start jumping to buy the stock. It pushes price up right into this place where we want to sell. Protective stop above, and then you can see that was a big drop away. We actually had a 100-point drop there on Amazon. So you could either short sold the stock right there, or even if any of you do that, you can buy some put options there as a replacement if you think the stock is a little too expensive for you there. But great little setup. But what are we doing? We're turning the trap into money. So we're not the ones being trapped. We're the ones that are actually joining them, right? Remember I said if you can't beat them, you got to join them. Here's another example here. Great little setup that Sam had on Uber. He was doing this in front of our live members in the forum. Here's Uber on a 180-minute chart. Here's our pattern. We had a little drop, base drop. You can see this big gap away in price, indicating a very, very strong amount of supply there. A lot of institutional selling at this area. So Uber was trickling its way back up to our level. Well, what helped us? An upgrade. So sure enough, Uber Technologies, they get an upgrade from the Royal Bank of Canada right on the 27th. The initiation was covered. Think of what everyone does. They're saying, oh, we got a price target here at 65. So everyone thinks, oh, it's going to go from 50 to 65. I need to jump on and I got to get on board. And all it does is encourage them to hit the buy button right into the place that we want to sell. Big drop away in price, right? So think about the buyer there. They got caught by that trap. Now, if that buyer understood our strategy of supply and demand, they would never hit the buy button into an area like this. As a matter of fact, they would be hitting the sell short button or maybe even purchasing puts out of that area right there. But again, you're getting caught by the traps. But the institutions need us to do that, right? Because whenever they want to buy, they need people to sell. Whenever they want to sell, they need people to buy. And upgrades and downgrades are just a great way to kind of bait the novice investors to take in the other side of their trade. But if we can recognize what they're doing on the chart, we're not buying here, we're actually selling right along with them. So hopefully that makes a little sense for you guys there as well. But the key to success in this is just really understanding the structure and location rules so that you can recognize what they're doing, okay? But here's things that we never focus on here at the Pinnacle Institute. We never focus on traditional technical analysis. And the main reason why is these are all lagging indicators, right? That's your moving average, MACD, slow stochastic, RSI, CCI, all that stuff right there, right? But more importantly, this is the Novice Playbook. The big banks and institutions know the signal that those novices are looking for, and they actually create the signal to get them to buy where they want to sell or sell when they want to buy. We don't use the chart patterns. If you look at every single chart pattern, I don't care which one you look at, double top, double bottom, head and shoulders, cup and handles, wedges, every single one of those will teach you to buy high on a breakout or sell low on when the price is breaking down. The exact opposite of what we're trying to accomplish. Trend, I mentioned that. Trend gets you in very late. By getting in late, it increases your risk, decreases your rate of return, and oftentimes puts us into the novice space. Now, the novice space is something that we want to avoid. So when we talk about a strategy, there's two things that we consider: structure and location. So oftentimes the trend will put you into the wrong location on the chart. Do you identify the news or just use supply and demand? Oh, you know what I do, Jose? When it comes down to news, whenever I hear news on a company, good or bad, what I do is I look at that stock. And if it's pushing up real big on the news, I might be looking for a supply zone. Or if it's pushing down real bad on the news, I might be looking for a demand zone. I don't if that makes sense for you. So oftentimes news can kind of give us the idea to look at something, but I'm not buying off the news. I'm always buying off of the chart on that. So hopefully that makes sense and handles your little question and comment on there, okay? But make sure you get rid of the trend, because oftentimes we're going against the trend here. We're buying down trends and selling up trends. We don't use support and resistance. Too subjective. And actually most of your common traps will come from it. That's where your bull traps and bear traps are more likely to be found. And ask yourself, if you're buying support and buying support levels and it's breaking your support and then reversing very quickly on you, you're probably getting caught in a trap, right? So you have to better understand the method of supply and demand in order not to get caught by that. And then news and earnings, right? Most of them trade that incorrectly. Most of people will chase it, right? The good news comes out, they'll run and buy. The good earnings comes out, they'll run and buy. We actually should be doing the exact opposite, right? No, we actually don't trade it. We don't trade with trend or momentum at all. No, because when we trade with momentum at all, it actually makes us miss the opportunity. So we don't wait for any kind of confirmation or, they always say, don't catch a falling knife. Will I catch it if it's in an area that you're confident about? Because that's going to be your lowest risk, highest reward opportunity, right? But actually, a lot of your news will be more of the contrarian. I think Warren Buffett probably said it best. You may have heard this quote before. He said, you should be greedy when everybody's fearful, but be fearful when everybody's greedy, right? So that's what you got to be really, really careful of, right? A great example right now is at AMC, right? You got all those people buying AMC way, it's gone from like 12, $6 a share up into like the 60s. And people are buying it right now, buying it way up here. Based off of what? Based off of Reddit or Wall Street bets? There's no fundamental information behind that, right? Those are just gamblers out there. We don't gamble, we invest, okay? And then the fundamentals, right? These are the things that get people buying high and selling low. And actually AMC is a perfect example of that. You could have a company that has horrible fundamentals. Like AMC is basically a company fundamentally should be bankrupt. But what is the stock doing? It's sitting up at $60 a share. So you have some stocks that have terrible fundamentals and they're really high, or they'll have great fundamentals like Amazon did and then trade lower, right? So this is something we don't use at all, right? You want to trade what is real, not what you feel, okay? Don't get sucked into a lot of these traps here because they're often going to have you buying high and selling low. Exact opposite you want to do. Keep it simple, everybody, right? You just want to keep your charts clean. No indicators, no oscillators, no trend lines, no volume, nothing like that. It's just the picture and pattern that the candle makes. So here's Sam looking at the S&P. Here's a nice little demand zone. But keep in mind, everybody, just because prices go up doesn't mean it's demand. And just because prices fall down doesn't mean it's supply. It has to meet all the criteria, right? So it's important to understand why that's not demand, but that is. That's not demand, but that is, right? And that's what we have to teach here at the Pinnacle Institute is the rules behind structure and location. So we want to help you understand why this is a great place to buy because it meets all of our criteria and this is not. Because if you did trade off of that little area there, you kind of got caught in a trap. Like this is a good little support trap right there. Everybody in the world who read a book is going to have a little line right there. They buy right there, breaks the line, triggers their stop, they sell right into the demand level. So we don't want to be buying right there. We're going to be buying down here. And that's what we want to help you guys out with. It's just start to kind of understand the rules and criteria around our strategy. And that's what you'll get a lot of in our workshop. So, if you're not familiar with any of the strategy right now, I encourage you to do the introductory one. These are complimentary workshops that you can attend. Here are the next 3 dates that we have coming up. You can just simply click on the link that's in the chat and you can register for the one that works best for your schedule. Now, if you do already have some experience with Sam's side and strategy of supply and demand, I recommend you go to this one because we're going to assume that you already know the basics and we want to just give you some information that can take your analysis to a whole new level. So we look forward to kind of seeing you guys all there. So I wanted to keep this session, try to keep it within an hour or so. But if you enjoyed the content today, certainly give me a like down the bottom and do subscribe because what you're going to see on a weekly basis is us putting out all amazing content to kind of help you guys get better at what you're doing and learn more about the financial markets and our strategy. But thanks for attending, everybody. It was great having you. Enjoy the weekend coming up and happy Father's Day to all the fathers out there. Thanks, everyone.